Well, hello there. It's August the 9th. It's a Friday. Thank God it's Friday. Boy, what a week, right? What we're looking at is the E-mini S&P. We had employment data yesterday. Employment is solid. Jobless claims are on par. There's nothing to worry about in terms of recession right now, okay? The S&P touched this is the E-mini S&P, touched the 50-day moving average yesterday, and right now overnight we're seeing it trading slightly below that average. Now, keep in mind, we saw quite a bit of a bounce the last 3 days. So I'm not expecting another major bounce. There's a good chance we're going to drift sideways today. It's Friday. Friday's the most non-directional day. Here's something for you that's important. Keep your eye out. Again, we breached it yesterday on the way up. The 50-day moving average is at 2940 if you're looking at the SPY, or 2,940 if you're looking at the E-mini S&P. If we break above, the price point I would be looking at is around 2940 if you're trading the E-mini S&P. If you're trading the SPY, I would look at 294. That's the level of the 50-day. And if we start closing above that level, that means the market is moving back into bullish territory. Right now, we're still technically in between the 50-day and the 200-day, which would be right here. Let me go ahead and put it on here so you guys could see where we're at least overnight. See, that's the 200-day moving average. That's the 50-day moving average. And when we're in between this line, I call it the Twilight Zone, okay? So we're right now literally in the middle of a Twilight Zone. We're going to open a little lower. As you see here, this is the overnight data. We're not going to open for another hour and 8 minutes or so, around there. So again, look for a little bit of a selling pressure. Look for mostly random trading pressure. China and US have not worked anything out, and that means markets are going to be reacting to that. The last 3 days, what we've seen is a reaction from the downside selling pressure. Also, if you look at volatility via the VIX, this is short-term volatility. Let me put it on here for you. If you notice, it's heading lower. It already breached the 50-day line, and even though the market's lower, it's still heading down, which is telling us it's up about 7%, but again, you could see it's been moving down all the way from 24. Anything above 20, folks, on the VIX. VIX is the short-term volatility index. This measures the S&P 500 at-the-money options implied volatility level. So what you're looking at right now is the implied volatility in the broad market. And this tells us the fear level in the broad market. And it looks to me like the fear level is coming down. This chart is looked better on a line chart. Let me make it a line chart and you can see what I'm talking about here. Notice it's already near the averages. Once it goes below this line, below 15, markets are complacent. We're still a little bit fearful, but not too much. So expect us to drift around, position ourselves, and wait for more data next week. Earnings were better than expected. 75% of them, of the S&P earnings, about 400 out of 500 were better than expected. It's not a bad sign, but remember, revisions took earnings lower substantially. So the fact that we're a little bit higher than expected is not such a big deal because they were bumped down so much. I mean, they were just dragged down. So again, things are stable. There's nothing to worry about. If we look at momentum, let's take a look at momentum real quick before I let you go. It is Friday. If we look at momentum levels, all these pop-up ads, my God. If you look at percentage of stocks over 20-day moving average, these are percentage of stocks in the broad market trading above the 20-day moving average. It looks like we're bottoming out right here, and it looks like we're going to get higher. If you look at this, this is the broad market. This is the overall market. And if you look at a longer period of time, you could see here that once we go below 20, it typically comes up. Few times it goes all the way down to 11, but not often. Even if you look at it on a 5-year basis, you'll see that it does come down sometimes, but usually, once it goes down below 40, unless it really comes down, it tends to come back up. So if we do go down, we could expect a little bit more, which would take us again to between the 50 and the 200-day moving average. And everything I'm seeing, let's look at the SPY. This is what we were looking at without the overnight data. And we're expecting to open down to about 192 level. Let me show you a 9-month chart. And now let's go back to bar charts. Here we go. I could do this all day long. As you can see here, we're slightly above the 50-day moving average. That line is at, let's see, the high is at 293.62. As I said, 290, not 263, 293. And the point we want to look at is 294. 294, if we trade above 294, there's a good chance we'll see some buy stops getting hit. There is a good chance, based on what I'm seeing, that we're going to drift, because we did go up the last 3 days. There's a good chance we're literally just going to drift between the 50-day and the 200-day. So either we drift and see more volatility, or we see a break above 294 on the SPY or 2,940 on the E-mini S&P. Either way, I'm not expecting a really strong market today because bulls are a little bit exhausted. The fact that fear is coming down a little bit via the fix, and the fact that we're already closed above the 50-day moving average is a strong sign. Expect the market to rally over the next 3 or 4 days, but be cautious. We have to be cautiously optimistic because remember, China and US have not resolved anything. Have a great weekend. I'll talk to you on Monday. Take care.